We're starting to hit overdrive this week in terms of news flow, both from companies and also on the macroeconomic front. Top down, the main features will be policy decisions from the Bank of Japan on Wednesday the 23rd of January and the European Central Bank on the 24th. Now, with inflation still running below its 2% target, the Bank of Japan is expected to leave its headline interest rate unchanged at minus 0.1% and stick to its quantitative easing monetary stimulus target of 80 trillion yen a year, or £575 billion a year. Do note, however, the BOJ is currently undershooting that target. Its balance sheet expanded by barely 31 trillion yen last year, and its asset base actually shrank month on month in October and December. Whether this is because the BOJ is having second thoughts or it's running out of bonds, real estate investment trusts and stock market trackers to buy, well, that's open to debate. But this trend must be watched. Remember, the American Federal Reserve is already draining away QE, and you can argue this loss of cheap liquidity is potentially affecting global stock markets. Now, this chart shows the Bank of Japan's balance sheet, columns, and the year-on-year growth in assets in yen, the line, since 2013, when the BOJ launched its latest QE scheme that April. Now, the same themes apply to the European Central Bank on the 24th. President Mario Draghi is expected to hold the headline interest rate at 0, and as of December, the Monetary Authority stopped adding to its QE scheme. Again, that may be depriving financial markets of the cheap cash in which they have basked for the last decade or so. Here we can see the ECB's total balance sheet and the year-on-year change in assets since Draghi pressed the QE button late in 2014. Now again, this loss of liquidity means that corporate earnings will need to be strong to give global stock markets a bit of a spark, and we have a clutch of results releases and trading statements from FTSE 100 and FTSE 250 firms due in the coming week. They include online grocer and potential software licensing player Ocado and bookmaker William Hill on Monday the 21st of January, airline EasyJet on the 22nd, miner Antofagasta, luxury goods leader Burberry and pubs group JD Wetherspoon on the 23rd, and telecoms giant Vodafone on the 25th. But for all of those names, the stock perhaps most capable of causing a fuss in the week ahead is another miner, Anglo American, which is scheduled to release a fourth quarter production update on Thursday, the 24th of January. Now, as we can see here, shares in the diamond, copper, coal, iron ore, platinum, palladium producer have largely paddled sideways over the past 12 months. And that's not so bad, given how the FTSE 100's fallen by around 12% over the same time frame. However, worries over the Chinese economy do seem to have weighed on many mining stocks, including Anglo's, as China's been a key consumer of raw materials over the past decade. And we can see the Bloomberg Commodity Index here over the past year. The spot price index, well, that's fallen by 7% across a basket of over 20 commodities to reflect those Chinese concerns and also fading confidence in the concepts of a synchronized global economic upturn. Equally, China may now be looking to cut taxes and try and give growth a boost, so we'll see. Now, overall, in terms of Anglo's products, diamonds had a mixed year, and in this next graphic we can see the price changes for Anglo American's other major outputs. The good news is palladium's going gangbusters. It's a key raw material in catalytic converters and clean car engines, a hot area amid ongoing concern over diesel emissions. Less encouraging, well, they're the price drops in iron ore and particularly Dr. Copper, so called because the ductile metal is seen as a bit of a bellwether for the health of the global economy. This is important because Anglo is not really looking to generate substantial production growth, so pricing is probably more important to it. This chart shows its guidance for full year production growth for 2018, and this is really your benchmark for the trading update, although you'll also need to keep an eye open for any comments on production forecasts for 2019. In sum, at the third quarter stage, Anglo American boss Mark Cutifani was targeting the following based on the midpoints of his guidance. Copper output up 11%, thermal coal up 9% and metallurgical coal up 7%, platinum, palladium and diamonds all up 4%, and then, tail end Charlie, iron ore, down by more than a fifth due to the production shutdown at Minas Rio in Brazil. When it comes to Anglo American's full year results, which are usually late February, analysts will start to home in looking at further reductions in debt, perhaps increases to cash returns, and maybe even comment on the group structure. There is one or two analysts out there talking about even a breakup. But more on those themes next month. Thank you for watching, and I look forward to seeing you next time.